Question 1. Which of the following statements best describes the role of underwriting in casualty insurance? A. Underwriting is primarily focused on claim settlement processes and involves adjusting claims after they are reported. B. Underwriting assesses risk and determines the premium rates for insurance policies, ensuring that the insurer remains financially viable. C. Underwriting is solely concerned with marketing insurance products to potential clients and does not involve risk assessment. D. Underwriting ensures compliance with state regulations and oversees the licensing of insurance agents in Massachusetts. Answer. B. Underwriting assesses risk and determines the premium rates for insurance policies, ensuring that the insurer remains financially viable. Explanation. Underwriting is a crucial process in casualty insurance that involves evaluating the risk associated with insuring a client and determining the appropriate premium based on that risk. This process considers various factors such as the applicant's claims history, loss ratios, and potential liabilities. Underwriting helps ensure that the insurer can cover potential claims while maintaining profitability. According to Massachusetts insurance regulations, proper underwriting practices are essential to mitigate adverse selection and ensure that premiums are commensurate with the risks being assumed. Question 2. Mr. Thompson has just received a notice that a claim for bodily injury has been filed against his business, stemming from an accident that occurred on his premises. What should Mr. Thompson's first step be in handling this situation? A. Contact his insurance agent to discuss the claim and determine the coverage limits of his general liability policy. B. Immediately hire a lawyer to defend against the claim before understanding the details of the incident. C. Ignore the claim as he believes it will not lead to a settlement. D. Prepare a detailed report of the incident and gather witness statements before discussing the claim with his insurance provider. Answer. D. Prepare a detailed report of the incident and gather witness statements before discussing the claim with his insurance provider. Explanation. In this scenario, Mr. Thompson's best course of action is to document the incident comprehensively. Preparing a detailed report and collecting witness statements is crucial for several reasons. First, it allows for accurate representation of the facts during the claims process. Second, having a well-documented account of the event can aid in the investigation conducted by the insurer and provide necessary information for potential legal defenses. Massachusetts law emphasizes the importance of timely and thorough claims reporting under the Fair Claims Practices Regulations, which mandate that insured parties cooperate with their insurers during claims investigations. Question 3. Which of the following factors is NOT typically considered during the underwriting process for casualty insurance? A. The applicant's prior claims history and loss ratios. B. The applicant's credit score and financial stability. C. The type of risk management practices the applicant has in place. D. The marketing strategies used by the applicant's business. Answer. D. The marketing strategies used by the applicant's business. Explanation. Underwriting focuses on assessing the risk associated with insuring a particular entity. This involves analyzing the applicant's claims history, loss ratios, and the effectiveness of risk management practices. While an applicant's financial stability may influence underwriting decisions, the specific marketing strategies employed by the applicant are not relevant to the underwriting process. These factors are aimed at ensuring that the insurer can effectively evaluate the risks being assumed and set premiums accordingly. The Massachusetts Division of Insurance stipulates that underwriting must be conducted on the basis of objective risk factors to avoid discrimination and ensure fairness in the insurance process. Question 4. What is the primary purpose of the Massachusetts Division of Insurance's regulatory framework? A. To enhance the marketing techniques used by insurance companies to attract clients. B. To ensure that all insurance policies sold in Massachusetts meet state standards for coverage and pricing. C. To promote the financial performance of insurance companies without regard to consumer protection. D. To limit the competition among insurance providers by enforcing monopolistic practices. Answer. B. To ensure that all insurance policies sold in Massachusetts meet state standards for coverage and pricing. Explanation. The Massachusetts Division of Insurance serves to protect consumers by enforcing regulations that ensure insurance policies provide adequate coverage and are fairly priced. Its regulatory framework is designed to promote transparency and accountability among insurers, ensuring they operate in a manner that protects policyholders' interests. Regulations set forth by the division include the approval of policy forms and rates, as well as monitoring the financial health of insurers to prevent insolvency and guarantee that claims can be paid. Ensuring compliance with consumer protection laws is central to the division's mission. Question 5. A business owner has a general liability insurance policy with a $1 million limit. If a judgment of $1.5 million is awarded against them for a slip and fall incident on their property, what will be the financial outcome for the business owner? The insurance will cover the entire judgment amount since it is within the limits of liability. B. The insurance will cover $1 million and the business owner must pay the remaining $500,000 out of pocket. C. The insurance will deny the claim due to exceeding the policy limits. D. The insurance will pay $1.5 million and the excess will be transferred to the business owner's next policy year. Answer. B. The insurance will cover $1 million and the business owner must pay the remaining $500,000 out of pocket. Explanation. In this scenario, the general liability insurance policy has a limit of $1 million. When a claim exceeds the policy limit, the insurer is only obligated to pay up to the specified limit. Therefore, the business owner is responsible for any amount that exceeds this limit. This situation underscores the importance of understanding policy limits when purchasing insurance. Massachusetts law requires insurers to clearly disclose coverage limits in the policy documents, allowing insured parties to make informed decisions regarding additional coverage, such as umbrella policies, which could provide extra protection beyond the standard limits. Question 6. Which of the following practices is considered a violation of ethical standards in the insurance industry? A. Providing clients with comprehensive explanations of their policy coverage and exclusions. B. Accepting gifts from clients to maintain a positive business relationship. C. Offering premium discounts to clients who demonstrate good risk management practices. D. Referring clients to other specialists when additional expertise is needed for complex claims. Answer. B. Accepting gifts from clients to maintain a positive business relationship. Explanation. Accepting gifts from clients can create a conflict of interest and is generally viewed as unethical within the insurance industry. Such practices can compromise the integrity of the agent-client relationship and potentially lead to biased decision-making regarding claims or underwriting. The National Association of Insurance Commissioners (NAIC) emphasizes ethical conduct and transparency, asserting that insurance professionals should avoid actions that could be perceived as favoritism or corruption. Ethical standards require agents to act in the best interests of their clients without being influenced by external incentives. Question 7. In the context of workers' compensation insurance, which of the following statements accurately describes the principle of exclusive remedy? A. Workers can sue their employers for damages in cases of gross negligence, even with workers' compensation coverage. B. Workers' compensation provides full restitution for pain and suffering without any limitations. C. The exclusive remedy principle prevents workers from pursuing additional legal claims against their employers for work-related injuries. D. Employers are not required to provide workers' compensation coverage if they can prove that the injury was not work-related. Answer. C. The exclusive remedy principle prevents workers from pursuing additional legal claims against their employers for work-related injuries. Explanation. The exclusive remedy principle is a foundational concept in workers' compensation laws, including those in Massachusetts. It stipulates that employees who suffer work-related injuries or illnesses must seek compensation through the workers' compensation system rather than through litigation against their employers. This principle serves to provide a streamlined process for receiving benefits while protecting employers from potentially crippling lawsuits. However, there are exceptions, such as instances of intentional harm or when the employer does not carry required workers' compensation insurance. Massachusetts law emphasizes this principle to balance the interests of both employees and employers. Question 8. What is a significant difference between first-party and third-party claims in casualty insurance? A. First-party claims are made by policyholders for their own damages, while third-party claims involve claims made by others against the policyholder. B. First-party claims can only be filed for property damage, whereas third-party claims can include bodily injury claims. C. First-party claims are automatically paid by the insurer, while third-party claims require negotiation and settlement. D. First-party claims do not require any documentation, while third-party claims must include extensive evidence. Answer A. First-party claims are made by policyholders for their own damages, while third-party claims involve claims made by others against the policyholder. Explanation. First-party claims occur when policyholders file claims to receive compensation for their own losses or damages under their insurance policy. In contrast, third-party claims arise when someone who is not a party to the insurance contract seeks compensation for damages or injuries inflicted by the policyholder. This distinction is crucial for understanding the claims process in casualty insurance. For example, under a general liability policy, a business may face a third-party claim from a customer injured on its premises, while the business itself would file a first-party claim for damages to its property. Massachusetts law outlines the rights and responsibilities associated with both types of claims to ensure proper handling and resolution. Question 9. Which of the following statements about liability exclusions in casualty insurance policies is true? A. Liability exclusions allow insurers to deny coverage for specific types of claims that are deemed uninsurable. B. Liability exclusions cannot be modified or removed from a policy once it is issued. C. All liability exclusions are considered illegal under Massachusetts insurance law. D. Liability exclusions only apply to commercial policies and do not affect personal policies. Answer: A. Liability exclusions allow insurers to deny coverage for specific types of claims that are deemed uninsurable. Explanation: Liability exclusions are specific conditions or situations outlined in an insurance policy under which coverage is not provided. These exclusions are legal and common in the insurance industry, allowing insurers to limit their exposure to certain high-risk situations or activities. For example, many liability policies exclude coverage for intentional acts, pollution, or specific types of professional errors. Massachusetts law requires that exclusions be clearly stated in the policy documentation, allowing policyholders to understand the limits of their coverage and make informed decisions about their insurance needs. Understanding these exclusions is crucial for policyholders to ensure they have adequate coverage for their specific risks. Question 10. What is the role of loss ratios in underwriting and risk assessment for casualty insurance? A. Loss ratios help insurers determine the appropriate marketing strategies for their products. B. Loss ratios indicate the proportion of claims paid compared to the total premiums collected, influencing pricing and underwriting decisions. C. Loss ratios are primarily used to evaluate customer satisfaction with claims processing. D. Loss ratios serve as a legal requirement for insurance companies to disclose their profitability to state regulators. Answer: B. Loss ratios indicate the proportion of claims paid compared to the total premiums collected, influencing pricing and underwriting decisions. Explanation: Loss ratios are a key metric in assessing the profitability and performance of an insurance company. It is calculated as the total losses claims paid divided by the total premiums collected. For example, a loss ratio of 60% means that for every dollar collected in premiums, 60 cents are paid out in claims. Insurers use this information to make informed underwriting decisions and adjust pricing strategies. A high loss ratio may prompt an insurer to increase premiums or tighten underwriting guidelines to ensure financial stability. In Massachusetts, insurers must adhere to regulations that govern how loss ratios are calculated and reported, ensuring transparency and fairness in the pricing of insurance products. Question 11. In Massachusetts, which of the following is a key requirement for an insurance company to be licensed to operate in the state? A. The company must have a minimum number of policies in force at all times. B. The company must maintain a minimum surplus to policyholders as mandated by state regulations. C. The company must provide unlimited coverage options for its clients. D. The company must conduct a specific number of advertising campaigns each year. Answer: B. The company must maintain a minimum surplus to policyholders as mandated by state regulations. Explanation: In Massachusetts, insurers must maintain a minimum surplus to policyholders as a condition for licensure, ensuring they have adequate financial resources to cover their obligations to policyholders. This requirement is in line with regulatory practices aimed at safeguarding consumer interests and ensuring the financial stability of insurance providers. The Massachusetts Division of Insurance assesses the financial health of insurers and enforces compliance with these requirements to minimize the risk of insolvency and protect policyholders. Additionally, insurers must adhere to regulations regarding reserve requirements, capital maintenance, and surplus lines to ensure ongoing viability. Question 12. What are the implications of the occurrence basis in a liability insurance policy compared to a claims-made basis? A. An occurrence policy covers claims that happen during the policy period, regardless of when they are reported, while a claims-made policy covers only claims reported during the policy period. B. An occurrence policy is more expensive than a claims-made policy because it offers broader coverage. C. A claims-made policy covers events that occurred before the policy inception as long as the claim is made during the policy period. D. There is no difference between occurrence and claims-made policies, and both provide the same coverage. Correct answer A. An occurrence policy covers claims that happen during the policy period, regardless of when they are reported, while a claims-made policy covers only claims reported during the policy period. Explanation: in liability insurance, the distinction between occurrence and claims-made policies is crucial for understanding coverage terms. An occurrence policy provides coverage for incidents that occur during the policy period, regardless of when the claim is actually filed. This means that claims can be reported years after the incident as long as it occurred during the active policy period. In contrast, a claims-made policy only covers claims that are made while the policy is in force, regardless of when the event causing the claim occurred. This structure can create gaps in coverage if claims are filed after the policy has expired, prompting insured parties to consider tail coverage for additional protection. Question 13. Mr. Thompson operates a food truck business and is concerned about liability coverage. He is considering whether to purchase a general liability policy or a commercial auto policy. What should Mr. Thompson consider as the primary difference between these two types of coverage? A general liability policy covers only injuries on his property, while a commercial auto policy covers any injuries regardless of location. B. A general liability policy provides coverage for bodily injury and property damage caused by business operations, while a commercial auto policy specifically covers vehicles used for business purposes. C. A general liability policy is less expensive than a commercial auto policy, regardless of the level of coverage. D. A commercial auto policy covers all types of risks associated with food service, while a general liability policy does not cover food-related claims. Answer: B. A general liability policy provides coverage for bodily injury and property damage caused by business operations, while a commercial auto policy specifically covers vehicles used for business purposes. Explanation: Mr. Thompson must understand the distinctions between a general liability policy and a commercial auto policy. A general liability policy offers coverage for bodily injury, property damage, and personal injury claims arising from business operations, including incidents occurring on or off the business premises. In contrast, a commercial auto policy specifically addresses liability and physical damage related to vehicles used in the business, such as his food truck. Each type of coverage serves a different purpose, and he should assess his specific risks to determine the appropriate insurance needs. Massachusetts law requires businesses to maintain adequate liability coverage for their operations, emphasizing the importance of having both general liability and commercial auto insurance if applicable. Question 14. Which of the following statements accurately reflects the responsibilities of insurance adjusters in claims management? A. Adjusters are primarily responsible for marketing insurance products to prospective clients. B. Adjusters have the authority to settle claims without the need for approval from the insurer. C. Adjusters investigate claims to determine the validity and extent of coverage, ensuring proper compensation is offered. D. Adjusters only handle first-party claims and do not deal with third-party claims. Answer: C. Adjusters investigate claims to determine the validity and extent of coverage, ensuring proper compensation is offered. Explanation: insurance adjusters play a crucial role in the claims management process by investigating the circumstances of claims, assessing damages, and determining whether coverage applies based on the policy's terms. They gather evidence, interview involved parties, and review documentation to evaluate the validity of claims. This comprehensive approach ensures that claimants receive fair compensation in line with their policy's coverage. Adjusters must adhere to ethical guidelines and regulatory requirements, including those set forth by the Massachusetts Division of Insurance, to maintain fairness and transparency throughout the claims process. Question 15. In Massachusetts, what is the significance of the notice of cancellation requirement for insurance policies? A. It allows insurers to cancel a policy at any time without notifying the policyholder. B. It ensures that policyholders receive timely notification of any changes to their coverage. C. It mandates that insurers provide a 30-day notice before canceling a policy, ensuring policyholders have time to find alternative coverage. D. It requires that all cancellations be documented by the Massachusetts Division of Insurance. Answer: C. It mandates that insurers provide a 30-day notice before cancelling a policy, ensuring policyholders have time to find alternative coverage. Explanation: Massachusetts law stipulates that insurers must provide policyholders with a written notice of cancellation at least 30 days prior to the cancellation date, except in cases of non-payment of premiums where the notice period may be shorter. This requirement serves to protect consumers by giving them adequate time to seek alternative insurance coverage, thereby minimizing the risk of being uninsured. The notice must detail the reasons for cancellation and inform the policyholder of their rights. This regulatory framework helps maintain stability in the insurance market and safeguards policyholders from abrupt cancellations that could leave them vulnerable. Question 16. What is the purpose of the subrogation process in casualty insurance? A. It allows insurers to reclaim funds paid for a claim from the party responsible for the loss. B. It is the method by which insurers determine the premiums to charge policyholders. C. It is a legal process that allows policyholders to appeal denied claims. D. It enables insurers to provide refunds to policyholders for unused coverage. Answer: A. It allows insurers to reclaim funds paid for a claim from the party responsible for the loss. Explanation: Subrogation is a key process in casualty insurance that allows insurers to recover costs associated with claims from third parties that are found liable for the loss. After compensating a policyholder for a covered claim, the insurer can pursue legal action against the responsible party to recover the amount paid out. This process helps keep insurance premiums low by ensuring that costs are not absorbed solely by the insurer. In Massachusetts, the subrogation process is governed by both statutory law and insurance contracts, and it must be clearly outlined in the policy provisions. Insurers often require policyholders to cooperate in the subrogation process, which can include providing necessary documentation and testimony. Question 17. In casualty insurance underwriting, what does the term loss exposure refer to? A. The financial impact of claims paid by the insurer in a given year. B. The potential for financial loss faced by an insured party due to specific risks. C. The average premium amount charged to policyholders across all types of coverage. D. The practice of denying coverage based on past claims history. Answer: B. The potential for financial loss faced by an insured party due to specific risks. Explanation: Loss exposure is a fundamental concept in insurance underwriting that refers to the potential for financial loss resulting from specific risks associated with an insured entity. Insurers assess loss exposures to determine the appropriate coverage, limits, and premiums for individual policies. This assessment involves evaluating factors such as the nature of the business, the types of risks involved, historical loss data, and risk management practices. By accurately assessing loss exposures, underwriters can better price policies and establish coverage terms that reflect the true risk profile of the insured. Massachusetts regulations emphasize the importance of thorough risk assessment in underwriting to ensure that policyholders receive fair and adequate coverage. Question 18. Mr. Garcia owns a small construction company and is reviewing his liability insurance coverage. He has been advised to consider an umbrella policy. What is the primary benefit of obtaining this additional coverage? A. It covers all business-related expenses, including payroll and material costs. B. It provides excess liability coverage above the limits of his existing policies. C. It eliminates the need for any primary liability policies. D. It only covers legal defense costs in the event of a lawsuit. Answer: B. It provides excess liability coverage above the limits of his existing policies. Explanation: An umbrella policy offers additional liability protection beyond the limits of existing liability insurance policies, such as general liability and commercial auto insurance. This coverage is crucial for businesses like Mr. Garcia's construction company, where the risk of significant liability claims can be substantial. Question 19. In Massachusetts, what is the primary purpose of the personal injury protection (PIP) coverage required under auto insurance policies? A. To cover damage to the insured's vehicle in the event of an accident. B. To provide coverage for bodily injuries sustained by the insured and passengers, regardless of fault. C. To reimburse medical expenses incurred by the insured for any health-related issues. D. To cover legal fees associated with lawsuits resulting from car accidents. Answer: B. To provide coverage for bodily injuries sustained by the insured and passengers, regardless of fault. Explanation: Personal injury protection (PIP) coverage is mandated under Massachusetts auto insurance laws to provide immediate medical and related benefits for injuries sustained by the insured and passengers in an automobile accident, regardless of who is at fault. This coverage typically includes medical expenses, lost wages, and rehabilitation costs, offering financial support in the wake of an accident. The aim of PIP is to ensure that injured parties receive prompt care without the need for lengthy litigation to establish fault, thereby facilitating quicker recovery and minimizing the financial impact of accidents. Question 20. What is the Unfair Claims Settlement Practices Act as it applies to Massachusetts insurance regulations? A set of guidelines for promoting healthy competition among insurance companies. B. A law that prohibits insurers from engaging in deceptive practices when settling claims. C. A requirement for insurance adjusters to provide monthly reports on claims handled. D. A framework for evaluating the performance of insurance agents in the state. Answer: B. A law that prohibits insurers from engaging in deceptive practices when settling claims. Explanation: The Unfair Claims Settlement Practices Act in Massachusetts establishes regulations that insurance companies must follow to ensure fair and equitable treatment of policyholders during the claims settlement process. This law prohibits insurers from engaging in practices such as denying claims without reasonable justification, failing to provide timely responses to claims, and misrepresenting policy provisions. The goal of the Act is to protect consumers by ensuring that insurance companies handle claims in good faith and adhere to ethical standards, promoting transparency and accountability within the industry. Question 21. When evaluating risk in commercial insurance, what is the significance of a loss history report? A. It provides an estimate of potential future claims based on current market trends. B. It is used to compare the insured's business with industry standards for premium pricing. C. It details past claims and losses experienced by the insured, influencing underwriting decisions. D. It summarizes the coverage options available to the insured for their policy renewal. Answer: C. It details past claims and losses experienced by the insured, influencing underwriting decisions. Explanation: A loss history report is an essential tool in commercial insurance underwriting as it provides insurers with a record of the insured's past claims and losses. This report helps underwriters assess the risk associated with providing coverage to a specific business, as a history of frequent or severe claims can indicate high potential future losses. By analyzing this data, insurers can make informed decisions regarding policy terms, limits, and premiums, ensuring that the coverage reflects the actual risk presented by the insured. An accurate loss history is vital for both the insurer and the insured to manage expectations regarding coverage and costs. Question 22. Which of the following describes the duty to defend as it relates to liability insurance in Massachusetts? A. Insurers are only required to provide legal defense if the claim is found valid. B. Insurers have an obligation to provide a legal defense for any claims made against their insureds, even if the claims are ultimately unfounded. C. Insurers can choose whether to defend their claim based on its merits. D. The duty to defend is limited to only criminal cases involving the insured. Answer: B. Insurers have an obligation to provide a legal defense for any claims made against their insureds, even if the claims are ultimately unfounded. Explanation: In Massachusetts, the duty to defend is a critical obligation of liability insurers, meaning they must provide legal defense for any claims brought against their policyholders, regardless of whether the claims have merit. This obligation is rooted in the principle that the insurer is responsible for defending the insured against potential liabilities that may arise from their actions. Even if the insurer believes that the claim may be unfounded, they must still provide a defense until the matter is resolved. This principle underscores the protective nature of liability insurance and the expectation of insurers to support their policyholders in legal matters. Question 23. In which scenario might a coinsurance clause (ECA) property insurance policy come into play? A. When the insured decides to cancel the policy early. B. When the insured fails to pay premiums on time. C. When the insured property is not insured for a percentage of its actual value. D. When a natural disaster occurs. Answer: C. When the insured property is not insured for a percentage of its actual value. Explanation: A coinsurance clause in a property insurance policy requires the insured to maintain coverage at a specified percentage of the property's value, commonly 80% or 90%. If the insured fails to meet this requirement and suffers a loss, the coinsurance clause may result in a penalty, reducing the claim payout based on the actual coverage provided versus the required coverage. This mechanism incentivizes policyholders to insure their properties adequately, thereby ensuring that they are financially protected against significant losses. In the event of a claim, the insurance company will calculate the payout based on the ratio of the actual coverage to the required coverage, potentially leaving the insured with a financial shortfall. Question 24. What is the primary purpose of a waiver of subrogation clause in an insurance policy? A. To allow the insured to receive full payment for a claim without any deductions. B. To prevent the insurer from pursuing recovery from a third party after paying a claim. C. To limit the coverage provided under the insurance policy. D. To enable the insurer to cancel the policy at any time without notice. Answer: B. To prevent the insurer from pursuing recovery from a third party after paying a claim. Explanation: a waiver of subrogation clause is an agreement that prevents the insurer from seeking recovery from a third party after they have paid a claim on behalf of the insured. This clause is commonly included in contracts between businesses and their clients or contractors to promote goodwill and protect relationships by ensuring that neither party can pursue financial recovery from the other after a loss. It is particularly relevant in scenarios where multiple parties may share liability for a loss, allowing each party to operate without the concern of being sued by their insurer for recovery of claims paid. However, parties should consider the implications of such waivers carefully, as they can affect the risk exposure of the involved entities. Question 25. In Massachusetts, which of the following practices is prohibited under the insurer's duty to investigate regulation? A. Insurers must conduct thorough investigations before denying a claim. B. Insurers are allowed to delay claim processing to gather additional information without notifying the insured. C. Insurers can settle claims based solely on the testimony of a single witness. D. Insurers may not require the insured to provide documentation that is irrelevant to the claim. Answer: B. Insurers are allowed to delay claim processing to gather additional information without notifying the insured. Explanation: under Massachusetts regulations, insurers are required to conduct timely and thorough investigations into claims and must communicate transparently with policyholders throughout the claims process. Delaying claim processing without proper notification to the insured is considered an unfair claims settlement practice. Insurers must provide clear reasons for any delays and keep insured parties informed about the status of their claims. This regulation aims to protect consumers from arbitrary or unfair treatment by insurers and to ensure that claims are handled efficiently and justly. Failure to comply with these duties can result in regulatory action against the insurer by the Massachusetts Division of Insurance. Question 26. What is the main purpose of an act of God clause in a property insurance policy? A. To limit coverage for damages caused by natural disasters. B. To provide additional coverage for damages resulting from criminal activity. C. To exempt the insurer from liability for losses caused by unavoidable natural events. D. To require the insured to pay a higher deductible in case of natural disasters. Answer: C. To exempt the insurer from liability for losses caused by unavoidable natural events. Explanation: an act of God clause in a property insurance policy specifies that the insurer is not liable for damages caused by natural events that are beyond human control, such as hurricanes, earthquakes, floods, or other disasters. This clause serves to protect the insurer from being held accountable for losses that occur due to these unpredictable and uncontrollable forces of nature. While such clauses are standard in many policies, insured parties should be aware that they may need to purchase additional coverage, such as flood or earthquake insurance, to protect against these specific risks. Question 27. In Massachusetts, what does the term replacement cost mean in the context of property insurance? A. The value of the property based on its current market price. B. The amount needed to repair or replace damaged property with similar materials and quality without depreciation. C. The total costs associated with selling the property. D. The minimum amount the insurer will pay in the event of a total loss. Answer: B. The amount needed to repair or replace damaged property with similar materials and quality without depreciation. Explanation: replacement cost in property insurance refers to the amount it would take to repair or replace damaged property using materials of like kind and quality without accounting for depreciation. This means that if a covered loss occurs, the insurer will pay the insured the cost to replace the damaged property with a new equivalent, rather than paying the actual cash value, which considers depreciation. Understanding replacement cost coverage is crucial for policyholders as it ensures they can restore their property to its original condition without incurring out-of-pocket expenses due to depreciation. Question 20. What is the role of a deductible ECA property insurance policy? A. To reduce the overall premium cost of the policy. B. To specify the maximum amount an insurer will pay for a claim. C. To determine the insured's share of the loss before the insurer pays a claim. D. To provide additional coverage options for specific perils. Answer: C. To determine the insured's share of the loss before the insurer pays a claim. Explanation: the deductible is the amount that the insured must pay out of pocket before the insurance company covers the remaining costs of a claim. It serves as a cost-sharing mechanism where the insured takes on a portion of the risk and the insurer provides coverage for the remaining amount. The deductible can be a fixed dollar amount or a percentage of the total loss depending on the terms of the policy. Higher deductibles often result in lower premiums, but they also mean that the insured will bear a larger share of the financial burden in the event of a claim. Question 29. Which of the following is a key feature of liability insurance in Massachusetts? A. It covers the insured's own property damage in case of an accident. B. It protects the insured against legal claims for bodily injury or property damage caused to others. C. It provides coverage for the insured's medical expenses resulting from their injuries. D. It eliminates the need for an umbrella policy. Answer: B. It protects the insured against legal claims for bodily injury or property damage caused to others. Explanation: liability insurance is designed to protect individuals and businesses from legal claims resulting from injuries or damages they may cause to others. This type of insurance covers legal fees, medical expenses, and settlements related to claims of bodily injury or property damage for which the insured is found liable. Liability insurance is crucial for businesses and individuals as it provides financial protection in the event of lawsuits or claims resulting from accidents, thereby safeguarding the insured's assets and ensuring compliance with legal requirements. Question 30. In Massachusetts, what is the primary function of the Division of Insurance? A. To provide financial assistance to policyholders in need. B. To regulate insurance companies and ensure compliance with state laws. C. To handle all claims filed by policyholders against insurers. D. To provide legal representation for policyholders in disputes with insurers. Answer: B. To regulate insurance companies and ensure compliance with state laws. Explanation: the Massachusetts Division of Insurance is the state agency responsible for overseeing the insurance industry, ensuring that insurance companies operate in compliance with state laws and regulations. The division monitors the financial health of insurers, reviews rates and policies for fairness, and protects consumers from unfair practices. By regulating insurance providers, the division aims to maintain a stable and fair insurance market while safeguarding the interests of policyholders across Massachusetts.